All right, let's jump right in. The US economy right now is sending some seriously mixed signals. I mean, on one hand, you hear about growth, but on the other, you're seeing these headlines that spark some real concern. So today, we're going to cut through the noise. We're going to try and decipher what the warning signs are in the latest data, and it really all starts with a number that tells a truly shocking story.
So let's start with this number, a number that really sent a jolt through the markets, negative 258,000. Now, this isn't just from one bad month. No, this is the staggering number of jobs that, they just vanished from the official reports for May and June, after the government went back and revised its own data.
And the latest report for July? It just added to the worry. The economy created just 73,000 new jobs. Yeah, on the surface, it's a positive number. I get it. But this really sets up the core contradiction we're digging into today, a gain that actually feels like a loss.
So yeah, that July number, it wasn't just a slowdown, it was a huge disappointment. It pretty much caught all the economists by surprise and sent a definite chill through the financial market.
You know, the gap between what was expected and what actually happened was pretty stark. Economists were forecasting around 110,000 new jobs, but the actual number fell way short. This signaled that the job market was cooling down a lot faster than anyone was really ready for. And it wasn't just that one headline number. When you dig a little deeper into the report, you see all these other warning signs popping up. The unemployment rate actually ticked up. The number of people who've been unemployed for a long time, that jumped significantly. And fewer people were even out there looking for work. Oh, and the manufacturing sector, it actually shed jobs. What's more, the job growth was also dangerously narrow. Get this, over 90% of all the net gains came from just two sectors, healthcare and social assistance. So if you take those two out of the equation, the picture looks incredibly fragile. That is not the kind of broad, robust growth that you want to see. But here's the real twist in this whole story. This weakness in the economy, it's not just a July problem. It turns out the slowdown was already happening. It was just hidden in the government's own initial data. Remember that negative 258,000 number from the beginning? This is where it comes roaring back. The realization that the labor market was 250,000 jobs weaker in the 2 months leading into July, it completely reframes our entire understanding of where the economy actually stands today. Let's just walk through how dramatic these changes were. So May's job gains were first reported as a pretty healthy 144,000. Then they were slashed to just 19,000. June was even crazier. It dropped from 147,000 all the way down to a mere 14,000 jobs. This is not a small correction, folks. This is a completely different story. And hey, you don't have to take my word for it. The Bureau of Labor Statistics, the very agency that puts out this data, they use the phrase larger than normal to describe these changes. You know, that's about as close as a government agency gets to shouting, whoa, you need to pay attention to this. Okay, so as if a slowing job market wasn't enough to worry about, there's another major force coming into play. The administration has rolled out a sweeping new set of tariffs, and that's adding a pretty big and unpredictable crosswind to the entire economy. And with this policy, you get two very different stories. The stated goal, of course, is to protect and grow American manufacturing. But then you have reports from the ground, cited by places like the Associated Press, describing a very different reality. Businesses feeling squeezed from all sides by rising costs. This quote from business owner Josh Smith over at Montana Knife Company, it really puts a human face on the issue. He needs a specific machine for his production line, right? But there isn't an American company that makes it. So for him, the tariff doesn't encourage him to buy American. It just acts as a tax on essential equipment that he can't get anywhere else. And these potential costs, they're not trivial. Research reported in places like the Times of India suggests these new tariffs could directly increase costs for U.S. factories by up to 4.5%. That's a significant burden that could affect everything from wages to hiring. So all of this, it places the Federal Reserve on this really perilous high wire. The central bank is now caught in a classic economic bind. You've got a cooling job market on one side and the threat of rising prices from tariffs on the other. The Fed is now staring down a fundamental choice. Do you cut interest rates to try and support the weakening job market? Or do you hold them steady to fight the potential inflation that could be caused by these new tariffs? I mean, there's just no easy answer here.
The dilemma is just so stark. On one side, you have the risk to jobs, the weakening growth, those shocking downward revisions. And then on the other side, you have the risk to prices, with tariffs pushing costs up even while inflation is still above the Fed's 2% target. It's a true two-sided risk. And Fed Chair Jerome Powell, he is publicly acknowledging this tightrope walk. At his press conference just before this jobs report came out, he made it really clear they're watching inflation, but this quote shows they are also highly focused on the, quote, risks on the employment side. And that weak jobs data, it completely changed the game for investors. According to the CME Fed Watch tool, the odds of the Fed actually cutting interest rates in September shot up to 67% right after the report came out. That's a huge shift in expectations, and it puts enormous pressure on the Fed to do something. So after all this big picture macroeconomic talk, let's bring it all home. Let's get to the bottom line. Why does any of this matter to you? How do these huge numbers in these policy debates actually connect to your wallet? Well, the ripple effects are very direct and very tangible. A weaker job market, that can affect your job security. The market volatility that we've been seeing, that can hit your 401k. Tariffs can mean you end up paying more for everyday goods. And whatever the Fed decides to do with interest rates, that will directly impact the cost of a mortgage, a car loan, or even just your credit card balance. And to put a really fine point on the cost of tariffs, research from Yale University's Budget Lab estimates they could translate to an extra cost of up to $2,400 a year for the average US household. That's not some abstract number. That's a real, tangible hit to your budget. And so we end with the economy caught in this really dangerous bind. Job growth is fading, but at the same time, policies are in place that could push prices higher. The critical question isn't just what comes next, it's whether the US is heading for a period where we all face the worst of both worlds, a weaker job market and a higher cost of living.